requires an required allocation.
Yep. Okay, so Jeff's 704C capital account post that collection is how much?
It wouldn't change.
And Pete's?
It would, you would get a deduct of 50,000 and an income of 10 or 100,000, so it'd go up 50,000.
Yep. And Pete and Jeff's 704B capital account were affected by that collection of AR and AP by how much?
The B account, nothing.
Nothing. Because the AP and AR were existing pregnant gain and expense when this was formed. Since it existed when it was formed, it goes to the contributing partner, which was Pete. So, what's Pete's 704C account?
Pete's is 0 to begin with.
And where does it end?
50,000 because we have to recognize the AR and AP.
Okay, and what's his fair value?
His fair value is $1 million.
What's the difference between those two numbers?
The inherent gain,
How much?
950.
How much inherent gain existed prior to the collection?
950.
No, $1,050,000.
$1,050,000.
And we recognized 100 on the asset side, 50 of expense on the liability side. Those had now gone away. The 950 of goodwill is still inherent gain that's yet to be recognized, and that ties to the variance between Pete's 704B capital account of $1 million and a 704C capital account of 50. What's the difference between those two numbers, Brad?
950.
How much inherent gain is my goodwill?
950.
950. So now I'm able to track the inherent gain that still resides in Pete's 704B and C capital account back to the inherent gain that exists on the balance sheet. Does everybody see that? Brett, you good?
Yeah.
Okay. So, I even did the math there. Huh. What is that? Oh, that's so fucking bad. What does the 4 with 2 arrows say, Brett?
The inherent gain only becomes a required allocation when goodwill is sold. However, see discussion on remedial allocation.
Okay. So that is something that you actually, in my view, want to highlight. Because if you ever want to become, a consultant, this is worth knowing. Because if you're representing somebody that is coming to the table with inherent gain, and part of that inherent gain is goodwill, you might want to take a note on this. You don't want to use the remedial method, and we'll demonstrate why. If you're the non-inherent gain partner, so in other words, Pete, to be specific on this page, does not want the remedial method. Jeff, the non-inherent gain partner, Jeff wants the remedial method. And I'm going to demonstrate this later, but on that call yesterday, where I was on the call with the attorneys, they were using the remedial method. Okay. Brad, who you want to call in?
We'll call Alyssa.
Okay, required allocations under 704. What are the methods? What are the methods the required allocations are measured and allocated to the inherent gain partners? Yeah, traditional method with curative allocation, and remedial method. How are the 3 methods utilized to make the required income allocation? The method must be chosen between the 3 options. Depreciation calculations must be made for 704B capital accounts. The partnership must quantify the tax depreciation deduction that will be taken on the partnership return, and the tax depreciation must be allocated to the 704C capital account based on the 704 method chosen.
Okay, this is where, Alyssa, we start getting nauseated. Okay, so let's go back to, what were the 3 categories of assets?
Short-term recognizable asset, depreciable assets, and then if sold in the future.
Okay, so the short-term recognizable asset, I believe everybody in the room has wrapped their head around what that means. The collection of cash-basis AR is a short-term recognizable asset. Yes? Mm-hmm. The sale of inventory that has appreciation in it, that's a short-term recognizable asset. Yes? Mm-hmm. Okay. A partnership interest or land, that's one that has to have a sale in order to have a recognition event in order to trigger the gain. So those two, I think we can capture those and say, we can see those as a required allocation because it's going to be, the methodology is calculate 704B gain, correct, Alyssa?
Yep.
And any appreciation on that is going to be a required allocation?
Agreed upon.
Agreed upon, right, Sam?
Yep.
Okay. And 704C has both required and agreed upon. Correct?
Yep.
And the required is going to key off of what?
The inherent gain.
The inherent gain that existed as of the date we formed the partnership. Correct?
Yep.
Okay. And the agreed upon is going to key off of
The partnership agreement or.
the partnership agreement, but it's going to key off of the 704B calculation.
Okay, yeah.
Because the agreed upon is going to be equal for 704C purposes, and it's going to be equal for 704B and C. Those two amounts should be the same. If they're not, something's off the rails for the required. 704B gain loss should be informative of how to allocate the 704C gain. That's a check figure. Your inherent gain is another check figure. You have 2 check figures that are embedded in 704C to make sure that you're on the rails. But this depreciable asset, that's a whole different thing. And the depreciable asset comes under 3 different methodologies: the traditional method with curative, and the remedial method. Okay, and for purposes of this, because man, I got lazy. I'm like, how am I going to express this? Okay, so we're going to do this on the fly, and I'm going to do it in here because I think this is going to potentially be helpful. We're going to say that we're going to do this because I'm blind as a damn bat. And we're going to say depreciable equipment, widget machine. I always like the old widget machine. That has a value, or excuse me, acquisition cost of $1 million. There we go. And I'm going to say accum. And we're going to do this first in the extreme. Net book value is how much?
0.
0. Fair market value, we're going to leave it at $1 million. Fair enough? Everybody good with the facts so far? So Jeff is going to contribute cash of $1 million. Okay, so Alyssa, who do you want to call in?
Kelsey?
Kelsey, is this a short-term asset that's going to convert immediately?
No.
Is it an asset that is long-term that we have to, that is only going to have a recognition event when we sell it?
No.
It's a depreciable asset, correct?
Yep.
Okay, so what's my Make this a little smaller. My eyes aren't that bad. Come on, you can do it. So what assets do I have on my balance sheet, Kelsey?
You have the widget machine,
Yep.
cash of $1 million.
Okay.
The widget machine, is this 704C or 704B balance sheet?
Let's make this, that's a good question. We'll make this C.
Okay.
Okay. And then we have what?
The widget machine, which would be $1 million with a cum of $1 million, so net book value of 0.
Okay. Okay, so my liabilities is what?
0.
Is 0. Equity.
Pete would be 0 because the net book value of the widget machine is 0, and then Jeff would be $1 million.
Okay. There we go. Okay, so we have our total, right?
Mm-hmm. Which is $1 million,
And then
$1 million.
million. Okay, and my 704B is what?
Cash of $1 million. Widget machine of $1 million with 0 cum.
Okay.
Liabilities of 0. And then Pete and Jeff both $1 million.
Everybody's on board so far. Have we done anything different? So my 704C, or my inherent gain, excuse me, is how much?
0 cash. The widget machine would be $1 million.
Okay.
And then liabilities 0, and then Pete $1 million, Jeff 0.
Okay, and again, what kind of asset are we dealing with?
A depreciable asset.
A depreciable asset. So right now, everybody seems to be on board. This is no different than what we've been talking about so far. Correct? No different. Everybody in sync with we haven't done anything different so far. So now we have to construct our 704B, 704C, cap account. We have Jeff, we have Pete, right? Or Pete and Jeff, let's keep it consistent. Total. What's Pete's?
0.
0. And what's Jeff's?
$1 million.
Million. Okay. Okay. Now we have, and believe me, this is going somewhere. I don't know where. This is going somewhere. Okay. And now we have in the copy. We have 704B, right?
Yep. And they would both be $1 million.
Okay. All right. Everything's the same so far. So, let me ask you a question, Kelsey. If I had a piece of ground in a former example, we had land A and land B that Pete and Jeff contributed. Do you remember the 704B basis of each piece of the ground?
Land A was 1,000.
704B.
Oh, both were 10,000.
Both were 10,000. And if we sold that ground, what was our 704B basis?
10,000.
10,000. So we have a 704B basis that's attached to that account, or that asset, correct?
Mm-hmm.
So is it fair to say that my depreciable property has a 704B basis in the same way my land has a 704B basis?
Yes.
Okay? So step one, under every methodology, is to recognize that your depreciable asset has a 704B basis equal to the fair value that was assigned to it when it came to the entity. So if we bought this asset, Kelsey, pushing aside any partnership tax concept we've been talking about, we bought an asset for $1 million, and we're going to depreciate that over a 5-year period over a straight line. How much depreciation do we have?
200,000.
200,000. Okay, so we're going to say fair market value of depreciable property. How much was it?
$1 million.
$1 million. Correct?
Yep.
5-year straight line. You said that was
200,000.
200,000. Okay. So step one, should we write down our steps on here just for the hell of it? Okay. So step one, follow normal procedure. And what do I mean by normal procedure, Kelsey? For step one. Identify the asset by partner.
Yep. 704C balance sheet, 704B balance sheet, and inherent gain.
Okay. So is everybody on board with what I mean by normal procedure? Okay. Okay, so step two is there depreciable property? So is there depreciable property?
Yes.
There is. Okay. So step three, if there is depreciable property, what method is being utilized? And that is, what were they? Traditional?
Traditional with curative and remedial.
Okay. Does that mean anything to you at all, Kelsey?
Not really.
Okay. We'll come back to it. Okay. Step 4. Calculate fair market value depreciation based on 704 B fair market value of depreciable property. So what was the fair market value?
$1 million.
$1 million. Okay, so right now, we were through step 4, are we not?
Yes.
Okay. So now, let's talk about and actually, honestly, step 3 and step 4 could be inverted. And actually, more appropriately, maybe they should be. Just from a development of a thought process. Because traditional, okay, I'm not gonna go down this path just yet. Okay? I'm gonna tell you what the procedure is, and then we're gonna go down the path. Kelsey, why do you think we calculate fair market value depreciation?
So when we're adjusting so we can adjust our 704B balance sheet.
Okay? So we're going to go year 1, year 2, through year 5, correct? And what's the goal of the 704B and 704C cap accounts, Kels?
To eventually equalize.
To eventually equalize, okay? So we have this concept of fair value depreciation. Hold on. So if nothing else happens and all we're dealing with is depreciation, if that's our only thing, our goal would be to equalize out our capital account. Oh, fuck, that's wrong. Like, what the hell? So, Kelsey, this is where I screwed up. What is the agreed upon allocation?
50/50.
And if I have 200,000 of total depreciation that's available, how much should go to Pete?
100,000.
100,000. I'm an idiot. Times 0.5. So, if we got into this partnership, and the partnership, we contributed $1 million of cash per person, and $1 million was deployed into a depreciable asset, we would get a deduction every year of $100,000 each. Is that how you would prepare a tax return?
Mm,
It is,
okay.
right? So if 2 people contributed cash to a partnership, our cash account is $2 million. Debit cash, $2 million. Credit equity for Pete and Kelsey for $1 million each. The partnership goes out and buys a piece of equipment for $1 million. It generates a $200,000 deduction for depreciation. There's not a book tax difference. We're pushing partnership tax concepts aside. You would get $100,000 of depreciation, and I would get $100,000 of depreciation. That's just normal tax preparation, is it not? Okay? So what this is saying is, if we bought the asset for $1 million, how much depreciation goes to each person? This would be an agreed upon allocation, correct?
Yes.
Okay. So then we have this 704B, 704C capital account, which is our required allocation. So our required allocation, here's the rule. Oops, what am I doing? And I am going to invert these. The more I think about it, they almost have to be inverted. Okay, because we're going to calculate the fair market value depreciation. Then we're going to assess which methodology we're on. We're going to invert those steps. Okay, so now you know the fair market value depreciation that's available. And if pushing the partnership concept aside, you would have gotten 100,000 Kelsey of depreciation, I would have gotten $100,000 depreciation. Okay, so now we've had the concept of a contributing partner who is an inherent gain contributing partner, and we have the concept of a non-inherent gain contributing partner, correct? And we have those 2 assets that are easy to wrap our head around, which was short-term asset, which was sold, and the second asset was the one that sells in the future. And we do our 704B gain loss, and we have the required gain allocation, and how does this work? Okay, so the starting point for the analysis is who is the non-inherent gain contributing partner. Okay, so step 5. Once you you know what? I'm gonna, because this is now gonna be step 4. Because again, I'm trying to develop a thought process, and this is more automatic in my head, and I'm trying to go down the path. So step 4 is who is the non-inherent gain partner. Okay? So who's the non-inherent gain partner, Kelsey?
Jeff.
Jeff. Okay? So now maybe I finally get to step 5. Traditional method, what methodology has been agreed upon by all the partners? Traditional with curative, or remedial. Okay, and I'm going to go back to step 4 a second. The reason I'm asking who the non-inherent gain partner is tells me this is a guidepost. The non-inherent gain partner, Jeff, has a fair market value allocation of depreciation of how much?
100,000 a year.
100,000. That 100,000 is a guidepost. It is an indicator of telling you what you need to do next. So, going back to our brief example where we're pushing the partnership concepts aside, we buy, you put in $1 million, I put in $1 million, we buy an asset at the partnership level, you get $100,000 depreciation, I get $100,000 depreciation. Well, we have a variation of that where Jeff put in $1 million and Pete put a depreciable asset in. So Jeff should get his fair value depreciation. So by virtue of calculating what the fair value depreciation, you use that as a guidepost to say, well, he gets that much of the tax depreciation. So the traditional method says you can only use the depreciation from the contributed item. Okay? So, step 1 is normal procedure. Step 2 is there depreciable property? Yes. Calculate the fair market value depreciation, which is 100,000. Who's the non-inherent gain partner, which is Jeff? How much? Well, you know what? Okay, we're going to insert here.
We're writing with pens.
Okay, well, this will be provided to you. Step 5. Yeah, no shit. Use the non-inherent gain partners 704B depreciation as a guidepost to determine how to allocate tax depreciation. Okay, so let's do this again. Follow normal procedure, which we agree what that is. Is there depreciable property? Yes. Calculate the fair market value depreciation, which is 100 each, which is the depreciable property that was contributed, divided by an agreed upon amount of time. You come to a fair market value depreciation that's available to Jeff and Pete. Allocate that fair market value depreciation to Jeff and Pete in proportion to the agreed upon allocation. Use that. Who's the non-inherent gain partner? Use the non-inherent gain partner 704B depreciation as a guidepost to determine how to allocate tax depreciation. Okay? And then the traditional method says you can only use the depreciation from the contributed depreciable asset. What is the depreciable contributed asset that was depreciable contributed asset, Brett?
The widget?
The widget machine. Okay? So, tax net book value. How much is tax net book value? Huh. Okay. 5-year straight line. How much tax depreciation do I have?
0.
0. So Jeff is owed $100,000 of depreciation, correct? From a fair value perspective?
Yes.
And traditional says that, what's that say, Brett?
You can only use the depreciation from the contributed asset.
Uh-huh. You can only use the, need to be more precise, because words matter. Use the what depreciation?
Tax.
From the contributed asset. How much tax depreciation do I have?
0.
0. So that says that there is no required allocation because there's something called the ceiling rule. When you use the traditional method, it's possible that you bump into the ceiling rule. Okay, so let's change the facts a little bit. And let's play with this because we're going to stick on the traditional method. And I'm going to say instead of $1 million, this is 500,000. What the fuck? Oh, I added that. What the hell? Escape plus. Oh, that's what I did. I'm an idiot. Okay, is all that track? We went through our normal stuff. Okay. Control C. Control V. Let's do. Well, I'm going to do this manually. So what's the rule that we have, Brett?
You can only use the tax depreciation from the contributed asset.
Okay, so how much depreciation is Jeff owed?
100,000.
How much do I have available?
100,000.
Okay, so look what just happened. There was 500,000 of depreciation, tax depreciation that was available. We didn't bump into the ceiling, but Pete gets 0 tax depreciation off that asset as we go, and Jeff gets 100% of it. Okay? So if we made this, these would all be 0, right? And it doesn't equalize.
And that's because the ceiling rules that you can only use the tax depreciation.
From the contributed asset. Or contributed assets. Because we could have a widget machine A that was fully depreciated, and which widget machine B that was newly acquired. And both those assets are contributed, and both would have a depreciation that we'd have to go through from a fair market value depreciation to figure out who gets what depreciation. But it's the population of the contributed assets, not just on an asset by asset basis. It's the population of depreciable assets that were contributed.
Okay.
Okay? So, does anybody have any questions yet? Are you sure? So, if we don't have any questions, let's do this, just to make sure that we're all here together.
I don't think I'm very happy if I'm Pete.
What do you mean?
Jeff's getting all my depreciation.
Fair enough. But Jeff's also giving me $1 million of value for a zero basis asset.
And you already got the depreciation.
And I already got the
Well,
depreciation.
no wonder you're revised to, there's 500,000 basis left.
If I'm Jeff, how do I get cured?
You don't. The only way you get cured in the zero, when you bump into the ceiling, is gain or loss on disposition of your partnership interest. That's the only way it gets cured. So the ceiling rule, if the ceiling rule comes into play, then the only way that gets cured is by disposition of partnership assets, and the goal to have your 704C tax count drive to equalize to your 704B cap account is not going to happen because you bumped into the ceiling rule.
You said you only get cured on disposition of the partnership,
Mm-hmm.
not disposition of the asset.
Nope. So, well, I said no too quickly. I think if you get to the end of the depreciable life for fair value, my answer is correct. I think if it gets disposed somewhere in the middle of the fair value, my answer might not be correct. So I'm going to go with I don't know on that. But I do know if you get to the end of the depreciable life of the asset and we bumped into the ceiling rule 5 consecutive years and we get to zero basis in that asset, that there is no cure for it. Because at that point, your 704B basis, so let's answer your question. If we get to the end of year 5, Brett,
Yep.
what's the net book value for 704B purposes?
Zero.
Zero. And if we sell it for $500,000, how much gain do we have?
500.
500. Now, and that's going to be split, the 704B cap account, is that required or agreed upon?
Agreed upon.
Agreed upon. So that gain's going to go 250 and 250, correct?
Right.
Okay. So now we go into our 704C cap gain. How much are our proceeds?
500.
What's our basis?
Zero.
Gain.
500.
So those two are going to be in concert with each other, correct?
From a gain perspective, yes, but it'll be required to Pete.
Because it's been fully depreciated for
Yeah. That's only on the future asset. Yeah.
Okay. So let's do this. Okay. Can you guys tell me what depreciation goes to Jeff and Pete? I'm going to change this.
Is it a 5-year asset?
Yep.
So for 704B, it would be 200,000 each year at the partnership level, and then if they're 50-50, it would be 100,000 to each. And then 704C, there would be 750,000 remaining.
Yep.
And then with the traditional method, you have the ceiling rule that says you can only
And
use,
we're only talking about traditional method at this point.
okay. Let me think. What's 750 divided by 5?
15,
50?
15,
15?
150,000.
Okay. So 150,000 over each year over 5 years.
Okay, so hold on. So even if you fuck this up, Kelsey, you're on it.
Oh, thanks.
Okay, so what's my 704 B cap account for Pete and Jeff?
They're each at $1 million.
So Pete and Jeff is $1 million and $1 million. So what did you do next exactly?
I calculated depreciation over the next 5 years for each
And how
of
much
them.
was it?
To 100,000 each.
But how did you get there? You're shortcutting on me. You're right, but how?
The fair market value of the widget machine is $1 million.
Okay.
So at the entity level, they'll take depreciation of 200,000 a year.
Yep.
And then if Pete and Jeff are 50-50, they'll each get 100,000.
Okay. Okay, and that's for a period of 5 years, correct?
Yep. So then at the end, they'll each be at 500,000, which will equal.
That's 3, 4, 5, correct?
Yep.
$500 and $500. Okay. So what about my 704C?
Pete is at 750, and Jeff is at $1 million.
Okay. Then what?
Now we need to depreciate the asset, which has a net book value of 750.
Okay.
So then over 5 years, that would be 150,000 each year.
Okay, and then your rule is what guidepost do you use to figure out how to allocate that 150,000?
A non-inherent gain partner,
And who was that?
Jeff.
Okay, and how much in the fair value column, because you're using the fair value column to key in on is the guidepost to say what tax depreciation code Jeff, correct?
Mm-hmm.
And how much is that number?
100,000.
100,000. Okay, and do we have enough tax depreciation to support that?
Yes.
Okay, so for a period of 5 years, Jeff is how much?
500,000.
Okay. So how much tax depreciation do we have overall?
150 each year.
How much do we use?
100,000.
So where do you think that additional depreciation pushes to?
Pete.
Your inherent gain partner. Okay? So Pete's depreciation is 50 a year, correct? Kelsey, what's 5 times 50? 250.
250.
Okay. Okay, what's 750 minus
300. 200. Wait, 750 minus 250?
750 minus 250?
500.
Wow, that was math Tourette's. I've never seen anything like that before. That was math
I need my
Tourette's.
10 key.
I did any number in infinity could have popped out of your mouth. I'm quite confident. And how much is that?
500,
500K.
and we equal.
And we equalize out. Okay, so the procedure, follow normal procedure. Is there depreciable property?
Yes,
Calculate the fair market value depreciation.
100,000 to each partner each year.
Yep. Who's the non-inherent gain partner?
Jeff,
Use the non-inherent gain partner 704B depreciation as a guidepost to determine how much tax depreciation to allocate.
which is 100,000 to Jeff.
Yep. And then, are we using traditional, curative, or remedial?
Traditional,
Okay. And then the traditional has the burden of having what rule?
the ceiling rule.
The ceiling rule. So if you don't have enough tax depreciation to support the fair value depreciation that should be allocated to the non-inherent gain partner, it just goes, it goes away. And to Brett's point, I don't know what happens when you sell it in the middle, but I suspect that if you sell it in the middle, there would be a portion of the gain that would go to the non-inherent gain or the inherent gain partner. But if it gets all the way through the fair value depreciation, then you gotta wait till the end. Leslie, how you feel about all this?
Okay.
Okay. Alyssa?
Yeah, good.
Sam? You need to be drunker tonight. Brett?
Good enough.
John?
Good.
Okay. Okay, so traditional with curative. Okay? So the rule is you can only use the tax depreciation from the contributed asset. Traditional with curative. Okay, so everybody understands traditional, you can only use the tax depreciation that comes from the contributed asset. Traditional with curative says, well, and I didn't know this, the way it was couched in grad school, and I think it might have been Pfeiffer who was taking a partnership class. The way I learned this rule was that if you added an additional piece of depreciation, depreciable property, you could cure the shortfall. So if we go back to the balance sheet, and if we had no depreciation available based on the asset that existed at the date we formed the partnership, if we went out and bought another widget machine for $1 million, then we would be able to use that $1 million newly acquired machine to allocate allocate depreciation to Jeff to cure the shortfall that existed on the asset that was contributed. So in this case, how much is the shortfall? Kelsey, who do you want to call in?
Brett.
Who?
Brett.
Brett, how much is my shortfall? How much did the ceiling rule?
100,000.
100,000. So we have a shortfall of 100,000, correct? So if we added another machine, and let's call it for $500,000, and it's straight line for 5 years, how much tax depreciation do we have due to the newly added machine?
100.
100. What do we owe Jeff?
100.
So Jeff would be able to harvest the depreciation off the newly acquired machine in order to cure that shortfall.
So if it was in for $1 million, the first 100 would go to Jeff, and then it's 50-50 for the rest.
Yeah. That's a very, very good question. So let's do that again. Did everybody understand Brett's question? Okay. And why would that be the conclusion?
Because you have your required piece, then you have your agreed upon for the rest.
That's right. That's 100% right.
What if they bought like a building for 39 years? How would that shake itself out?
You mean in terms of,
Yeah, say we're doing the second method with remedial, and then we buy a $1 million building, for example.
oh, well, it didn't have to be the same kind of asset. So if the shortfall, let's say, I think, let me rephrase articulate what I think your question is. If instead of a widget machine, we had a building that was fully depreciated, and then we added a machine that created depreciation, is that where you're going?
I was thinking like if we did the machine still, did a building, is the runoff over 5 years or would that get cured over 39 years?
It'd be over the 5 years. But the building depreciation probably is enough to harvest that out, harvest a portion of that tax depreciation out to cure that 5-year problem, would be my instinct. So traditional with curative says that I have the opportunity to cure by addition of depreciable property. That's the way I learned it in grad school. Or that was my impression of it. But when Fife went through, he said you had to pick a specific item of deduction and allocate that specific item of deduction, and you had to stick with that specific item of deduction. Is that right? Probably. I mean, Pfeiffer's generally pretty good at paying attention to what the hell's going on.
What do you mean by that? Specific item.
So I could say, well, I'm going to specially allocate my rent expense to cure the depreciation shortfall. There's going to be rent expense every year that I have to dip into to cure the depreciation shortfall. Or I could choose some item. That's what Pfeiffer said.
Does that have to be the same character?
One would think, but I don't know the answer to that. I'd be surprised if that weren't the case.
And that's once you would decide that you have to use that specific expense until it's cured.
Yeah. Well, for over the 5 years. So if that specific expense came up short in a given year, you're going to bump into the ceiling rule.
Mm-hmm. You can't flip it though. Like first year you want to do rent expense, next year you can't flip it to something.
That was not my impression from the discussion with Fife, so I'm going to stick with my grad school understanding and stick with depreciable property, because that always made sense to me, because it was of the exact same expense type, and that made sense to me since it was the exact same expense type. The addition of depreciable property using that exact expense type would cure the shortfall. That always made sense to me. This concept of using some other item of deduction didn't really make sense to me. But again, I mean, he had it. We were sitting in the conference room. He was going through Golden Gate. Okay. So let's talk about there were 3 options. Kelsey, what were they?
Traditional with curative, and remedial.
Remedial. Okay. Remedial is a free-for-all. It's the wild, wild west. We can just make up whatever we want to make the capital accounts get to the right spot. So if this is our fact pattern, where Jeff contributed cash of $1 million, Pete contributed a machine of $100,000 with a cum of $100,000, and this is the exact same fact pattern. So, Brett, we have with traditional, we have a ceiling problem, correct?
Correct.
With traditional, with curative, we have a ceiling problem until we add a new machine, and we still possibly have a ceiling problem, correct?
Correct.
Okay. The remedial says, well, wait a minute. This is the wild, wild west. We are going to make the allocation, we're going to do allocations to make the capital accounts drive to 0 at the end. So it's the same steps as we had before until you get to the allocation. So, Brett, what is my fair value depreciation?
200,000.
And allocated to Pete and Jeff and
100.
100 each. So how much depreciation do we owe Jeff?
Fair value?
Yep.
100.
How much tax depreciation do we owe him?
0.
No. How much do we owe him? Just
Oh.
What is a guidepost? Let
Yeah.
me be more precise in my question. Using book depreciation as a guidepost, how much tax depreciation do we owe him? 100. So the remedial method says, we don't care. We don't care if there's any sort of depreciation to support that. Jeff, fuck. Jeff is going to get his 100 depreciation. No matter what. So let's put this in the most stark of fact patterns. Jeff is owed 100 of depreciation. We're going to give him 100 of depreciation. And I'm going to pretend that we have no income, and this is not the way this works, but this is going to drive the point home. We have no income, and we have no expenses for 5 years. We don't collect a dollar, we don't spend a dollar. Everybody agreed on what our fact pattern is? So the remedial method says, well, if we have no income and no expenses, what's our book income and what's our taxable income that's going to be reported on the 1065, Brett?
0.
0. Well, we're saying that we're giving Jeff a K1 with a $100,000 deduction, are we not?
Yes.
So right now, I got a K1 that says $100,000 loss, correct?
Yes.
But I have no taxable income at all. What do you think the offsetting action would be? Would it be to jam Pete with $100,000 of income? So Pete's going to get a K1 with $100,000 of income on it. Jeff's going to get a K1 with $100,000 of expense. And those two are going to zero out because 100 of income to Pete, 100 of expense to Jeff is 0. That's exactly under my very bad fact pattern, fictitious fact pattern of no dollars of income, no dollars of expenses. Gets us back to 0. And what does that allocation do, Brett? Do we accomplish what 704B and 704C try to do in pushing the inherent gain to the proper party and equalizing the capital accounts? Does it do that?
Yeah.
It does. So the remedial method is a free-for-all.
It doesn't matter what type of expense you're allocating, as long as you get to the right answer in the end.
It can be rent, it can be depreciation, it can be whatever you want.
As long
Or
as it's a $100,000 loss in this case.
or in the inverse, okay? So there's a push and a pull, or a different way of looking at this. Let's pretend for 1 second that we just had $100,000 of income on an annual basis. If we said the $100,000 of income gets specially allocated to Pete and the 0 to Jeff, does that cure the problem?
No.
It does.
What?
Well, Jeff's going to have we're both going to have $100,000 on, I think it does. The point is, and I think you might be right, I think I might have a math problem on that. My point is, it can be an item of income can be shoved to the inherent gain partner, or an item of expense can be pushed to the non-inherent gain partner to equalize capital accounts. So it could be an allocation of either to make that true. Now, I think you busted me on a math problem, maybe, because I don't know that it does equalize if I have 100 of income. Well,
Yeah, if you have 100 income, you're shoving it all to Pete, then Jeff still has 0 loss.
yeah, they don't equalize. So I think I do have a math problem. But I know it can be either. I'm just going to stop there because I know I'm on shaky ground. Okay?
Which one do you see most common?
Well, what do you mean, what do you see most common?
The method, because that's what you
Oh.
used yesterday, right? The remedial. Is that what that was?
Well, let's go back to if I'm, well, I don't want to go here yet. I'm going to answer that question differently.
Is there something in the partnership agreement that says which one they have to use?
Can. certainly can, but that is generally going to be, you have to have somebody that has recognition that you want that in there for a specific reason. The more common is the partnership agreement is going to say 704C allocations are going to be dictated by the managing member of the partnership. That's more likely the language that's going to be in the partnership agreement. But, so I'm going to change this from, what if Jeff contributed $2 million in cash, and Pete's widget machine was worth $1 million, and we're still 50-50. Okay, so my equity section is how much from a fair value perspective, Stuthman?
3.
No, both were 50-50.
Oh. 4.
Okay? So Jeff's contributing us $2 million in cash. Okay? But the machine is still worth $1 million. Are we in balance on the 704B side?
No.
Okay? What do you suppose we're missing to get into balance? If my machine is worth $1 million and I'm getting $2 million of equity, what do you suppose I'm missing?
Goodwill.
Goodwill. Okay, so if we say that there's a goodwill component, wait a minute, there we go. We have goodwill, 0, that's $1 million. Oops. Are we now in balance?
Yes.
Okay. So the remedial method, traditional has a ceiling rule, correct?
Correct.
Traditional with curative has an allowance for an adjustment to the tax depreciation for additional assets added, correct?
Correct.
Remedial I described as the
Wild West.
Wild West free-for-all. So if, let me ask this question, Brad. If we were dealing with not a partnership concept and you bought goodwill and there's $1.5 million of acquisition cost associated with that goodwill, what's my annual write-off?
100,000.
100,000. So you would get $100,000 a year. Now let's take that to the next step to say that if we have $1 million of goodwill and we acquired that for 704B purposes, how much depreciation, and I should change it to $1.5 million for purposes of our example, how much 704B depreciation is available?
If it was $1.5 million, it'd be 100,000.
100,000. So if Jeff and Pete were 50-50 partners, Jeff would have how much 704B goodwill amortization?
75.
50, right? It was 100,000.
Oh yeah. Yep.
Okay. So now we're in the wild, wild west. It's a free-for-all. Going back to our original rule, and we highlighted this on a page earlier that said goodwill fell most likely into that third bucket. What was 3 types of assets, Noodles?
It was short-term, recognizable, depreciable assets and things that we will sell in the future.
And goodwill feels like something that falls in the self-created goodwill falls into the bucket of something that feels like we should be recognizing a gain only when it's sold in the future.
Yeah.
Under the remedial method, self-created goodwill, we have this $50 that's associated with that goodwill amortization that's due to Jeff. The remedial method says that came in at fair value. The remedial method says this is the wild, wild west. Jeff is owed that $50 of goodwill amortization. So, do you remember earlier I said if you're the inherent gain partner, you don't want the remedial method?
Correct.
Is the non-inherent gain partner, you want the remedial method? Because I, as the non-inherent gain partner, want my $50 of depreciation or amortization. As the non-inherent or the inherent gain partner, I don't want $50 of income jammed my way. Because if we sell the goodwill in the future, what's the character of that gain, Brad?
Capital.
Capital. If we have the remedial allocation that's going to jam $50 of income my way, what's the character of that gain?
Ordinary.
Ordinary. So there's two really bad things that just happened is non-inherent gain partner. One is, what's character?
Ordinary.
Ordinary. And when did it happen to me?
Right now.
Right now. And if we don't have remedial turned on, when is it inflicted on me?
Whenever you sell.
Whenever we sell it. So if I'm representing somebody that is getting into a partnership and there's this goodwill bucket that exists and they're the inherent gain partner, what am I trying to insist on in the partnership agreement?
Traditional.
Traditional, or traditional with curative, don't care. But traditional is most likely. If I'm the non-inherent gain partner, representing the non-inherent gain partner, what do I want?
Remedial.
Remedial. So going back to the page when I said, you know, it's that third bucket, goodwill falls into that third bucket of it's only going to be recognized when it's sold. And then I said, except we need to talk about the remedial method. This is why. So you want to make sure that you don't have the remedial method if you have goodwill in play. Because it's the wild, wild west. You can do whatever the hell you want.
So goodwill, even though we're getting a deduction like first year because it's amortized over 15 years, we don't cure it or do anything with that if it's traditional, right?
Correct. Yeah, and
So I guess like my thought is it feels like the second category. It's like getting
you know what? I've never thought about that.
You know
Because
what I
I've always, in my mind, once I turned off remedial, I've left that in the exact same category as land, in my mind. But what you said and what you just picked up on was the conversation Brett and I had a little bit ago when we bumped into the ceiling earlier. If we didn't have any allocation, then we get to the end and I have no value left under 704B, and therefore it's going to go under the agreed upon. I've never viewed it that way, and maybe I should have, because I'm saying for 704B purposes, that probably does have a deduction associated with it, which is not available, which bumps into a ceiling, which means that the goodwill should be allocated based on agreed upon versus required. But I've always treated goodwill as required. I don't know if that's the right answer, because I've never even thought about that before. Does anybody have any questions on that?
If you're the inherent game partner, this says inherent game partner does not want remedial. Is that only if it's goodwill or is it all the time?
That's a good question. What do you think?
That's what I'm asking.
What do you think, though? What's your instinct?
I want to say all the time.
That you want what?
That you don't want remedial if you're the inherent game partner.
That's exactly right. But you sure don't want it with goodwill. So Sam's question, which in my view is a next level question, is that, wait a minute, you just made the point on goodwill and not wanting to be harmed by that deduction from goodwill. Why isn't that true for all depreciable property? Why wouldn't you want, as the inherent gain partner, to always be in the category of traditional method? And I think you do. I mean, because if you bump into a ceiling rule, that's a good thing for the inherent gain partner. Bad for the non-inherent gain partner.
Aren't you gonna give Brad a coupon over there
Do
for
what?
his comment?
Huh?
Steuthman's comment that you said you'd never even thought of before? He
That's
doesn't get it.
depreciable.
Okay. All right. Here you go, Brad.
I mean, he gave it to a guy for picking up pigeons.
I did actually. He fucking deserves it. You guys know about this?
He's picking up dead pigeons.
You know
without
this,
a
right?
ring.
This Wyatt from CAS here?
Oh yeah.
White's in healthcare.
Healthcare. Healthcare? Okay.
During when he interned, or maybe his first year, I remember he was picking up dead birds on the.
He did it yesterday. He's still picking up dead birds out there.
He walks in, he grabs a trash bag, and he grabs some paper towels, and I don't know how Hoffman figured it out, but you figured out he was going outside to pick up dead birds.
It's like, what are you doing?
He's the designated dead bird upper.
Yeah.
They just banging y'all's building?
Yeah, in the windows.
And I'm like,
The cleaners are so good.
But when he said he's going out to get a pigeon, I said, well, here's a gift card for your services. And I still think the guy's getting screwed.
I want to pay you for this. Here's a gift card.
100%. And I don't think we're doing enough. I mean, Wyatt needs something for the pigeon pickup services here that he's providing.
It's all figured in, Pete.
I'm sure it is.
I told him to put it on his self-evo. That's one of his accomplishments.
I'm 100% on board. If that kid is dedicated enough that he's going to go out and pick up the dead birds, I think that is.
Do we not pay for a cleaner?
Right. That's what I said.
They don't pick them up.
So our veranda has carcasses if Wyatt doesn't do the job.
Yeah, there's some I feel like tax season. Sometimes they lay out there for a few days. And they just dump them.
You know, this conversation, I didn't know I was going to have this when I got up this morning. That's for sure. The dead bird conversation.
Well, it's really scary when you're working and one of them bangs against the wall and you're like, oh my gosh, like what just happened? Bangs against the window.
Yeah, I don't know what broke that window. So
Okay,
someone
but
thinks it's the building. No, it was not.
Brett and
someone-
Trent were the only people in the office when the window broke that night.
It's true.
That's
But it's happened. We have no clue. Trent and I were sitting there, and all of a sudden there was just a loud crash, and we looked over, and the window was shattered.
I don't believe a word of this.
It's exactly what happened.
Okay, so this is.
It was during opening night of NFL last year.
I'm sure football was being thrown somehow.
It was not.
There was So Christmas Eve, I was in the Omaha office,